You think of the world as there's beta and there's alpha. So there are returns that are risk premium that you collect by holding risky assets. So this is kind of buy and hold. You have a positive expected return. And then there are trades that you can make. And you know, in a moment, we'll get into your market views. But maybe just quickly summarize that distinction between the source of returns and then how you think about balancing those two in a well-diversified portfolio.
When it comes down to it, you can generate returns from three different sources. There's cash, the cash rate, essentially the central banks set what that is. You get it for free and with no risk in T-bills and stuff like that. There's beta, as you say, passive investing. And over time, you'd expect assets to outperform cash. And the reason why that is that the sort of fundamental construct of markets is that you forego the riskless cash return to hand your money to someone, whether it's to lend or to invest. And you would expect a higher return as a result than holding cash. And it's a reason why, if you look back through time, very, very rarely over meaningful periods of time does cash outperform assets. In fact, over any 1 year time frame, over any 12-month time frame, it's like 70-30 that assets outperform cash. And so the choice to overweight cash is actually an alpha choice, and you have to be darn good at that timing in order to actually have conviction that you should overweight cash, since so often assets outperform cash. And then the last choice, as you say, is making bets in markets. And when you think about a portfolio, you want to think about each one of those different pieces in a different way. First of all, you want to think about your overall risk tolerance. I mean, we talked about, can you absorb 75 or 50% drawdowns in your portfolio? Or say, for instance, you're getting close to retirement and you really want a lot of conviction about exactly, how much capital you have for retirement. And so that sort of gives you the sense of what's the choice between cash and assets, right? The amount of risk that you're willing to take in order to generate returns in excess of cash. And so that's different for every individual. And, you just want to think about that thoughtfully and proactively to target your return. And then when you think about assets, the real question is, how much do you want to put in passive investing versus active investing? And there's an important trade-off there, which is, passive investing generally has lower expected returns, particularly relative to the risk that you're taking, but it's more consistent. Right, more reliable. You would expect assets to outperform cash over time. Whereas alpha, you have the opportunity probably to get a better return relative to the risk that you're taking, but the reliability is lower. And so how do you balance these things? I mean, the frank reality is there's no obvious way to do it, because you have to take into consideration a variety of different things, including how reliable you think one is versus the other, how much skill you think managers have. I think if you look at big institutional managers, they're allocating something like 80% of their capital to beta in one form or another, whether it's liquid or illiquid, and about 20% of their capital to alpha strategies. And I think that basically is about right. In the sense of, in general, beta strategies are going to give you, pretty good consistent returns. So you really want to rely on that. But alpha can help protect portfolios, particularly in difficult times. And so you want to put something on it, but you don't want to go overweight it. So something like 80-20 makes sense, which, is the answer to every, it's either 80-20 or 50-50. Those are the answers to all of life's weighting questions.
Yeah, that sounds about right. And then I guess it's also, alpha is a zero-sum game. It's a negative-sum game if you add fees. In a lot of cases, maybe the managers can generate alpha, they can outperform, but they take that in fees, and the investors don't get as much as they might otherwise. So I think you have to weigh that as well. And passive investing just it's heading to zero in terms of cost.
Right, and fees, like the biggest issue for an investor is fees. And the reason why that is alpha is uncertain. Fees are certain, right? Whatever the fee is, what that management fee, certain. That pass through, let me tell you, it's certain and it's big.